Alright guys, welcome back to this episode. In this slide, we'll be dealing with the basic Forex terminology. Remember, I'm your host, Joseph Igoche. In this slide, we want to go the basic terms in Forex trading and how we can get acquainted with those registers to enable us ready for our Forex sessions. Yes, let's start. Number one on the list here is a broker. A broker is a financial services that provides traders access to a platform for buying and selling of foreign currencies. Right? And second on the list here is pips. A pip is a basic concept of Forex. Forex pairs are used to calculate exchange codes through bid and ask price. They are accurate to 4 decimal places. In simple terms, Forex traders buy or sell a currency whose value is expressed in relationship to another currency. The value of a pip can be calculated by dividing 1 over 10,000 or 0.001 by the exchange rate. For example, if the current price of Euro USD is 1.21746 and price moves to 1.32746, you minus the previous from the current price to get the number of pips movement. Your answer now will be multiplied by 100% to give you the whole number value. So let's say 1.32746 minus 1.21746 will give you 0.11. So 0.11 multiplied by 100 will give you 11 pips. So that's how to calculate pips on all pairs, right? And the study of pips is called pipsology. Next on the list is margin. Margin is the amount of money that a trader needs to put in forward in order to place a trade and maintain the position. Margin is not a transaction cost, but rather a security deposit that the broker holds while a trading position is open. It is simply the capital balance a trader must have to maintain an open trading position. Yes, when a trader has positions that are in negative or losses, the margin level on the account will rise. The trader's margin level falls below 100%, it means that the amount of money in the account can no longer cover the trader's margin requirements. The trader's equity has fallen below the used margin, and in this scenario, a broker will automatically close the losing trades from the highest to the lowest losing trades, or the trader will receive a margin call. Right? The next on our list is spread. The spread is the difference between the bids and the ask price. Right, the bid is the sell price, and then the ask price is the buy price of a currency pair. The higher the spread, the lower it is for a trading position to enter profits. The lower the spread, the faster it is for a trade to enter profits. So that's the reason why you have to choose brokerage firm that gives lower spreads, lower commissions, and then good leverage. Right? Now, leverage is the next thing we want to deal with. Leverage is the use of borrowed money, called capital, to invest in a currency, stock, or security. The concept of leverage is very common in forex trading. Leverage is the ability to use something small to control something big. Specific to forex trading, it means you can have a small amount of capital in your account, controlling a larger amount. In the market, leverage is usually given in a fixed amount that can vary with different brokers. Each broker gives out leverage based on their rules and regulation. The amounts are typically represented in different ratio: 1:500, 1:100, 1:200, 1:500, 1:50, 1:1000, 50:1, 100:1, 200:1, 400:1, etc. Now, for instance, the trader deposits $100 and chooses a leverage of 1:500. The trader's buying power in the market will be $100 multiplied by 500. So potentially, he has an account that is worth $50,000. So the trader can trade up to a $50,000 account. Professional traders usually trade with a very low leverage, and it's advisable a new trader uses a leverage ratio of 1:500. Keeping your leverage lower protects your capital when you are making trading mistakes and keeps your return consistent. Yes, the next on our list is commission. When opening a trade, no matter the direction, the first thing that will appear from a trading account is a commission. The broker charges for that transaction. This is deducted at the opening time of the trade, no matter how long the trade is being kept open. After all, brokers are not running a charity, and for the services they provide, giving access to the interbank liquidity market, they charge for a fee. This commission is deducted for the equity of a trading account, not from the balance. This is an important thing as it has a psychological effect on a trader's mind setup. The next on our list is swap or rollover. The Forex swap or rollover is a type of interest charged on positions held overnight in the Forex market. A similar swap is also charged on contracts for differences. This charge is applied to a nominal value on an open trading position overnight. Yes. The next is equity. Equity is the total amount of money a trader has in their trading account. That is their balance, plus or minus any profit or loss from open positions. If, however, the trade doesn't have any open position, his or her equity is equals to his or her balance. Alright guys, thank you for watching through this episode. Don't forget to like, subscribe, share, and invite family and friends. See you in the next course. Remember to always keep it principle, keep it simple, and keep it profiting. Blessings.